Hello, everyone, and welcome to another edition of CEO and Market Expert Interviews. I'm your host, Lucian. Some of you know me as Triangle Investor from X. I am always pleased to have experienced guests in my show, and this time I have a guest with more than 40 years of experience in global commercial nuclear fuel markets. I would like to welcome Dustin Garrow. Dustin, it is great to have you here.
Well, thank you, and I appreciate the chance to come on and share a few thoughts that have been developed over the last several decades. Let's put it that way.
Yeah, I believe more than few, but let's start. Let's start with your origin story, your background. Majority of uranium investors know who are you, but I would like that you share your rich background with my viewers, especially because we have everyday inflow of new uranium investors who maybe didn't hear of you. So please share us your background.
Okay, and I'll keep this short.
Sure.
I'm not technical. My background's economics, and I served in the U.S. Navy for a while. And when I came off active duty, it was the time of the oil embargoes. So we're talking the mid 70s. And energy, in my mind, was going to be a significant issue in the future. So I quickly gravitated to nuclear, because at that time, the US was forecasting 1,000 reactors were going to be built here. Now, we only got to 10% of that, but anyway, and then I quickly got onto uranium. I mean, the building block of nuclear. And so I've been in the business for coming up 50 years, mostly in the commercial side. I've worked for uranium producers, a big trading company. I worked for Converdyne. So over that time frame, you had to move around a lot. As you know, we had days of great optimism, days of huge depression.
Yeah.
And so it's been a great learning experience. But as I've told, and I think you're aware, my clients are Yellowcake, based in London, and Deep Yellow, which is in Perth, that's going to build the Tumas project. So I'll stay away from them. But as I told the board at Deep Yellow recently, I've never seen factors in this market that we have today. And it's both the supply uncertainty and constraints, and now the growing demand, which is just, I mean, it really is kind of overwhelming. So anyway, that's, my general background has been marketing of nuclear fuel products, pretty much uranium and conversion, but I focus on the term market more. I'm not, have a lot of experience in the spot market, but it's really the term market that drives this industry. And on a volume standpoint, as you're well aware, the utilities get about 80 to 85% of their uranium under term contracts. It's not in the spot market. That's just a tag end if they need some inventory or whatever. So the real market to watch is the term market. So I'll leave it with that, but that's kind of where I came from and where I am today.
Very impressive background. I had guests with 30 years experience, 40, but with 50 years experience, I didn't have any. So you're the first. We will cover both markets, like you said, term market and spot. Let's start with spot market. What is the current spot market status, so to say? What is your take on the spot market now?
Okay, well, let me give just a little bit of a background, I think, because it really impacts where we are today. The listeners need to realize that for years, there was overproduction of uranium well before commercial nuclear power came into development, basically. And so and I'm still trying to get an accurate number, but it's in the billions of pounds. Okay, so we actually had overproduction until 1990. So as commercial nuclear came into existence, started consuming more and more, we finally got into a situation where consumption exceeded production just about 35 years ago. But what that did was it had the effect of putting inventory overlying the market almost forever. Up until recently. So as the price would go up, someone somewhere, a smart trader, would liberate inventory, be it held by governments, by private entities, by utilities. And so you'd see the price strengthen, and then it would tend to drop off again. Well, as UX observed in, I guess it was August of 2022, they finished a big study of global inventory, and the number is still large. I mean, there's no question, but the mobile portion of that can really enter the market is down to minimal levels. And so that's what we're seeing. And at that time, UX put out a weekly that said the era of excess inventory is over. And I think that's what we're seeing play out now. In other words, like in the spot market, getting to that, as we saw the run up last year, particularly kind of after the WNA meeting, it was fairly limited volumes. And so I was asked the question, well, how can this happen? Well, as an economist, if you have limited supply and demand increases, you start to see the price go up significantly. Now, recently, we saw a noticeable downward move in the price, $7 basically in one day.
Yeah.
I was told that was based on 100,000 pounds being offered in the market by a trader.
Yes.
So, you know, I think going forward, talking to the price reporters, traders, we're going to see volatility in the spot price. It's going to be maybe all over the map. And as we've seen, it's now struggling a bit to get a back up from that significant down move in February. So the issue is the spot market is dominated by traders, by financial entities, such as even now the hedge funds have been buying when they can. And the actual consumer portion is not that big. The utilities and those producers that have been opting to buy to cover some of their deliveries really form a minor component in the spot market. So I think your listeners need to realize what you have are the financial traders in the market, and they have different business models. They sell, they buy, they do it on a small margin. You know, the guy that sold in February, he was with apparently a group that has their financial year end of March. So he needed to monetize some of the inventory. So it's not, it's utilities that will consume eventually, or producers that need to deliver maybe under long-term contracts and their production is, not quite up to par. So that's where we are with the spot market. And the volumes, I mean, if you look at it, they've been declining over the last couple of years. And interesting, the first quarter of this year, UX reports about 10 million pounds of transactions, which we've not seen that level since 2016, 2017. We could end up with a year of, below 50 million pounds. So again, it's an important part of the market. I think you can't ignore the spot price because it does influence, investors and even some of the producers. Because I'm asked when the price got to 100, why weren't new projects coming to the table on production? That's not what the suppliers need. They need that under term contracts, which we'll get to. So the current market, volume really pretty limited, price volatility pretty significant, and that's not going to change. So we'll see where it goes from here. But I see, Sprott was able to buy a couple 100,000 pounds last week, but they certainly have stepped back from the market. They were a huge factor, obviously, when they were first created, buying, 42 million pounds eventually. But last year it was what, 3.5. So again, they're not as big a factor because the pounds aren't there. They're
Yeah.
smart enough to know if they came in and wanted to buy £1 million, I was told that could take you a month
Yeah.
to try to put that together at increasingly higher prices. So
Yeah.
again, the spot market is going to be tricky going forward. Let's put it that way.
Yeah, and I believe that spot price sometimes causes nervousness in the market and sometimes sends wrong signals to both investors and utilities. I mean, term price is a better indicator of the industry heading than the spot price, right?
Absolutely. I mean, it's been the case for years that, when I first got involved at Paladin, which was 15 years ago, one of my stops along my career journey, I tried to get that message out that, yes, pay attention to the spot, but the term price is what will bring forth more supply when it's needed. And that kind of didn't fall on deaf ears, but I think the investment community is so focused on spot market prices across other commodities. But then when I think folks spend time with uranium, they realize that the market is unique. And so because of the long lead times and the like. So yeah, the term price. Now the question is transparency. The real challenge for the price reporters is the vast majority of term contracts have confidentiality clauses. So when you negotiate with a utility, and it's not just a U.S. utility, kind of any utility, there will be a clause that you are not to reveal the commercial terms and conditions of that agreement. So for the price reporters to get, let's say, current market information in the term market is a huge challenge. And that's never been addressed. In fact, the term price wasn't even published until the late 80s. It was all spot prices that were being published at the time. And I can remember when Trade Tech looked at it, they had a long internal discussion of should we try to publish a term price. So yeah, the lack of transparency is a real challenge. Now, obviously, it's been moving up, but it's been below what we've seen in the spot market.
Yeah, excellent point on transparency. Dustin, could maybe the uranium auction help the transparency? Is it possible? Can we see it in the past, maybe some form?
Well, I know this was brought up on one of your recent interviews with
Yeah.
Per. And just for kind of the background for the investors, I started an auction in 2006, I believe it was. And I represented a small South Texas producer, Mustania, which developed Alta Mesa, which has now been restarted by Encore. And the situation in the market was such, rather than being a price taker, we thought, okay, let's go out with our 50,000 pounds a month was the production stream. And we'd ask, I think it was 6 or 8 qualified buyers to submit an offer. In other words, we have 50,000 pounds, we can deliver it at ConverDyn. What is it worth to you? Okay, so we started out early in the year and the price was 25 cents above the posted price. So, I mean, it was $12,000. And I thought, well, that's not a bad deal. By the end of the year, it was $7 over the posted price. And the spot went from the mid 30s to 70. And actually, I was attributed, which was nice, by Trade Tech as being a major factor with my 50,000 pounds a month under, it wasn't an out, a typical auction where you sit and but it was, that by a certain date, submit your offer for this tranche. And so it worked well. Would it work today?
Yeah.
I think it would. So, is that, could we go in that direction?
In a
I
little
don't
bit
see why
different
not.
format.
Could be a different format, could be different players, but somebody says, I've got 100,000 pounds. And here are the delivery parameters. What is it? What's your value? How do you value it as a buyer?
Mhm.
And it could become really interesting.
Yeah.
So anyway, which again shows what happens in a supply constrained market. So
yeah, definitely. Let's cover term market. Dustin, what are you seeing and hearing there? Maybe some volume numbers. What's new on the term market?
well, the term volume has gone up noticeably, which we all kind of anticipated. Again, UX reported, I think last year, 160 million pounds, which is close to that kind of replacement rate. Interestingly enough, the US utilities only bought about 20 million or committed to buy. Just so the listeners understand, the term market is really one where generally a utility will come out looking for delivery starting maybe 2 years in advance and going for maybe 4 or 5 years as a base period. Now, not too long ago, that base period could be extended by the buyer for maybe 2 or 3 years under the same terms and conditions. So it was a clear buyer option. And I'm going to go through some of the terms here. Right now, what's happened is the base period has been extended a bit, and I don't see any options. So in other words, the suppliers are saying, I don't want that uncertainty of you exercising that option, because they're only going to exercise it when the market is in the favor of the buyer. So that's been a change. The other big change is annual quantity flexibilities, which was tend to just be given by the suppliers. And at times it was as much as plus or minus 20%. So if you had, say, a base quantity of 500,000 pounds, you were exposed as a supplier up to 400 to 600. And depending on when the buyer notified you, because again, it was only going to be when the market was in the buyer's, that when it made sense for them to do that. That's really gone, I've heard maybe 5%. And in most cases, it's zero. In other words, the suppliers are saying, that's a big risk that I don't want to take. Okay, so now getting on to the pricing side.
Yeah.
Obviously, when you sign a term contract, the price provisions can be a broad spectrum. It can go from a base price, which is escalated, up through a spot market at time of delivery, which tended to have a collar. So there was a floor and a ceiling. The logic being the supplier would say, I need some minimum price protection. The utility would say, okay, I then want a ceiling so I'm not exposed to a runaway market. Okay, so we'll get back to the collars in a minute. The market has moved more towards something that Cameco's done for years, which is referred to as a hybrid. So make it simple, we'll say half of it is that base price escalated, and the other half is marked to spot at time of delivery with a collar. Okay, so the base price is now 75 to 80. Who's the latest publisher, and it's gone up noticeably over the last few months. So again, it's driven by higher cost producers coming in the term market that need that higher price in order to move forward to build basically the green fields phase of the market. And cost inflation, you go down the list. So we're now, let's use $80. Yeah. And there's talk of, well, where does it need to go for greenfields? Is it 95? I'm hearing could be over 100. A big part of it is, what's the demand going to do? If you believe a limited demand growth, which nobody really believes anymore, then you don't need as much new production. But if you're at that 3.5%, 4% compounded growth, or you're going to triple nuclear by 2050, look at how much uranium that requires. Let's just say doubling over the next by 2040. So you've got to produce 350 million pounds. So it's got to come from mostly greenfields project. But just so you know, the term market, we're kind of coming up to the end of the what I call the restart phase. So we had the Paladins, the Encores, Boss. I put MacArthur River aside just because of the size.
Nice.
And Cameco came in the market quite a while ago to cover off needed contracts for that. But we had this group of, we're going to invest more capital like Paladin in order to bring Langer Heinrich back into production. But it wasn't a greenfields project. So in other words, it was a lower capital requirement, and it had a history of operating and delivering. So they were more receptive to say the base price below 60. I think we'll see that a lot of the contracts that have been done in the restart phase had the base price, let's use 60 or less. And then the hybrid, when you look at the collars, those have gone up. The floor was like 35 to 40. The ceilings were like 50, maybe 55, not that long ago, maybe a year and a half ago.
Yeah.
We're now looking at floors 75 to 80 and ceilings 125 to 130 escalated. Now keep in mind that collar escalates out. And we're also now hearing that some suppliers are willing to say to the utility, I want a floor price, but I won't give you a ceiling. So we see the term market is in transition from a very significant buyer's market post-Fukushima through kind of a balance, let's call it that, onto a seller's market, which makes it an interesting challenge if you want to enter the term market, say your greenfield project. How do you design that contract portfolio so you get enough contracts that support your financing, say particularly with a bank, so it's debt financing, because they want to have a certain level of revenue with a certain level of volume, but then also have the upside where you don't want to put a cap on what this very valuable commodity should bring to the shareholders. I mean, you don't want to limit that too much because, again, where's the spot price going? You know, I think you and I had a brief talk. I've always taken the position that it's impossible to forecast the spot price. Then it really is, because particularly when you have financial groups active in the market, they have a different strategy. So you can't just say, oh, well, you know, demand is going up with utilities and supply is this. And, you know, it's not like how many radiators will Tata build in India. And I'm hearing 150, sure. I heard 200. And then I've recently heard from some folks that are very active looking or buying in the spot, why not 300? Now, that may be getting out to the edge of the envelope,
Yeah.
but you go, well, it could, in fact, react like that. So you've got to be careful on how you design the term. So I think what we're going to see, we're still very early in the term contracting cycle. Unfilled requirements between now and 2040, 2 billion pounds I've seen, and more than a 1.5 billion. So when you really start looking at, yeah, Cameco, Orano, Kazatomprom, BHP, they're going to certainly fill part of that, but they're not going to be able to fill all of it. So you're really looking at an interesting time in the market where you've got to have more greenfields projects, and they're going to be at higher cost, therefore higher price. Yeah. So that's where we are kind of with the term market right now.
Yeah. Yeah, but would you agree that we have unclear situation with uranium production? You mentioned 2040, but I would say 2030. it's not 100% clear and transparent how many companies will actually start producing uranium by 2030. We have a situation where the production start deadlines are moving, postponed,
Yes.
etc. We have companies that claim they will produce, but there are a lot of technical and financial challenges waiting for them to achieve that. The newest example is NextGen. Looks like they said they were producing by 2027 or 8. Now it looks 2029. In my opinion, it will be well after 2030. What's your take?
Well, yeah, and I think you've hit the nail on the head, as they say. Between now and 2030, it's a limited number of potential producers anyway.
Yeah.
So you look at the restart guys. Okay, I think virtually all of them: Boss, Lotus, Paladin, Encore. I don't want to leave anyone out. Energy Fuels. But as Canaccord recently said, that's very positive, but it's kind of the proverbial drop in the bucket. You really need more bigger projects moving forward. DASA, okay.
Yeah.
Global Atomic was making, I think significant progress. Then they had the coup.
Mm-hmm.
So now, will that slow that project down? Yeah, I think probably, but
Definitely.
for how long? You start to get geopolitical issues, and how do you predict that? When will that be resolved to where they can move forward in a more meaningful manner? And they're looking at 3.5 million pounds. Not trivial, but certainly not particularly significant. And most of it's already, a good portion of it's been contracted. So you think, Deep Yellow, that's why I'm affiliated with them. I think Tumas looks good for late 26. We could do that based on contracts. Again, a big aspect of this market, and it was been brought out repeatedly, started at the World Nuclear Fuel Market meeting in Montreal, which was in 22, where the supply industry got up in front of most of the utilities and said, the future of supply is now in your hands as a consumer. We will not go forward without sufficient long-term firm commitments at sustainable prices.
Yeah.
And it was uranium, conversion, and enrichment. Now, we've not seen, in my mind, a lot of those kinds of commitments. There have not really been that many commitments to greenfields producers yet. They would have announced contracts. And we're coming up to the middle of 2024. And even if you've got all the factors pretty much in place, it's going to take a while. But as you say, the big projects, particularly in the Athabasca, that's where we're going to have to see even more production. NextGen obviously had a bit of a setback. We've got Denison with their in situ recovery, which looks good, but it's not been done on a commercial scale.
Yeah.
We've got Fission, we've got some others up there, but it's going to take years. Cameco has come out and said, if you want to build a new mill in the Athabasca, you're post 2030, because they've done it, and it's not by any means easy. So then we get to the Kazakhs. Okay, obviously a major producer, 55 million pounds. They've produced above 60. They've come out with announced challenges. Let's put it that way. Acid availability, transport, I think, is still difficult for them because they can't ship through St. Petersburg. Personnel, they've got to have a lot of capital to move forward with, with at least two of the projects. And one of them was to produce 15 million pounds by late 26, all going to the Russians, though. So that's another thing to keep in mind is the flow of material. People go, well, the Kazakhs said they're going to produce 80, 81 million pounds. I've been told by people active there that most of the uplift will go to China and Russia.
Mm-hmm.
So if you're a Western consumer, you can't really look to Kazakhstan. And then you probably saw just on April 4th, there was a very telling interview with the chairman of the board of Kazatomprom, and he made comments like, we're not chasing more production, and this is their value versus volume strategy. We want to extend the life of existing deposits, which almost suggests you don't push them harder. So again, the market is really abuzz on what we're going to hear coming out of Kazakhstan, particularly in August. They're going to talk about where they'll be in 25.
Yeah.
And I think this is just another factor. The other overlying issue is the Russian invasion of Ukraine, which is leading to a bifurcation in the market. Now, what does that mean? It looks like the Russians, even if they continue to deliver into the US and the EU, the utilities are already doing what's called self-sanctioning. In other words, as they look at new supplies, clearly they're not signing contracts with Russia. Now, Brazil did, okay. And so the Russians look like they'll have access to maybe 25% of the global market. So it's China, Middle East, South America. They could sell into Japan, but the Japanese, as they enter the market, they had only done a small contract with the Russians, and it was kind of a test contract before Fukushima. They are not going to rely on Russian supply. So although formal sanctions haven't been put in place, there's as you know, there's knock-on effects with transport. Port of Baltimore was a big import place. Well, that looks like it's off the table for a while. They have a shipment being held in Germany because they use plywood that is sanctioned, that's ballast for the ship. I mean, it's things like that are happening. But really more importantly, looking longer term for the Western supply sector on nuclear fuel components, uranium conversion, enrichment, fabrication, the utilities are pretty much self-sanctioning. And it's even worse for the Russians because Eastern Europe is moving aggressively to Western supply. I mean, you have Ukraine, Bulgaria, Slovakia was just out for up to 21 million pounds of future delivery. I don't think they're going to buy that from the Russians. So, Cameco has said that component of demand that was always the Russians to supply is as much as 15 million pounds, with Hungary, Poland, the Czech Republic, all moving toward more nuclear, and it's all going to be Western. So the supply sector in the West, which I have great sympathy for, I've spent a lot of time with it, because of underinvestment, is really now facing a huge challenge to increase output and then have an upside increment with all this extra demand coming in the market. And I'm sure we'll talk about SMRs in a minute, but that's something that is also ladling on more uranium demand.
Yeah, definitely. And you covered this excellent. We covered the first part, primary supply, but what about secondary supply? Some estimates say it's going to zero by 2030. My estimate is not maybe zero, but very close to zero.
Well, it's how you define that. I mean, in the old days, we had government inventories, DOE, Russian inventories that were sold into the market. We had underfeeding of enrichment plants, which generated millions of pounds of secondary supply. But keep in mind also recycling. So we get mixed oxide fuel and reprocessed uranium. That is the component that's likely to stay for an extended period. But it's at certain points we had 40 million pounds a year of secondary supply made available to the market. Most forecasts are say 10 post 2030, and it's recycle and MOX. So that's going to be kind of that component. But the rest of it is just not, where the enrichment plants are going from underfeeding to overfeeding, which requires more uranium.
Yeah.
Government inventories, people will say, and let me pick on US DOE, they have like somewhere under 20 million pounds. Most of it is not commercial. It's in HEU scraps, it's contaminated with technetium, so it would have further processing required before it can come in the market. Now, the big inventory is depleted UF6, and that's the global enrichment project with Cameco. That requires a new enrichment plant, which would be post 2030. And as Cameco said, eventually could result in a UF6 mine, but that's way out in the future. So yeah, the secondary supplies, which again had bedeviled the market, that's that inventory in various forms, is pretty much being worked down. There just isn't much of it out there to really be concerned about. So,
Dustin, what do you think? How are the Chinese preparing for the supply gap and their activities now and in the future?
Well, yeah, I mean, I don't want to bore the investors with the Chinese story. It's still very strong.
Yeah.
They have 55 reactors operating, something like that. At the time of Fukushima, they had 13. So they've continued, even though they took like more than a year off to evaluate the safety issue, they continue to move forward very aggressively. And they just came out and said 10 reactors a year is what they plan to approve. So you're looking at a program that's going to surpass the US 2030-ish. And they're saying eventually they want 400 gigawatts. So that would be, 200 million pounds of uranium eventually. Yeah. So when you look at the Chinese program, you go back to almost the start. And I attended some conferences in Beijing, and they said, don't look at point estimates. Look at this curve going forward, and we can develop conversion. We can build enrichment, which they have. We can build fabrication. Those are manufacturing plants. What we don't have is uranium. And again, the fundamental building block. They have some domestic reserves. Looks like they'll be doing better, but they can't produce more than, I've seen, 8 to 10 million pounds a year. So very early, they put in place what one would call a three-legged stool of spot buying, of term contracts, which they did a significant portfolio back around 2010. And so it had Cameco, Orano, Rio Tinto, Kazakhstan, Uzbekistan, and I think the total was over 200 million pounds to be delivered. Could be more. I actually have a summary I put together somewhere. So, and they're now been renewing those. I'm sure you've seen they did 2 contracts with the Kazakhs. They did a big contract with Cameco. Now, the other was to invest in production. So they started out with ASLIC in Niger, which they then put on care and maintenance. It just wasn't a very good experiment. But they bought Rossing from Rio Tinto. They've extended the life. They're, I think, will continue to produce maybe at a higher rate. And then Husab, they built as a new mine in Namibia, which was supposed to go to 15 million pounds. Most forecasts have 10 to 12. But the other thing that's important, and a little bit of a step back, a number of the big programs now, Russian, Chinese, South Korean, Japanese, Indian, and perhaps the Middle East are looking to invest in uranium production. They'll invest in exploration, I think, development, production, in order to ensure they have future supply. Now, the French obviously have Urano, so they pretty much use that. So getting back to the Chinese, I've been told by several sources, they already have a group going around. They've been in Australia, they've been in Brazil,
Yeah.
and they come in and they say, we need more uranium. How can we get it from producers in this country? Can we contract? Can we invest? Where is it? What does it cost? So it's a very large group that they're sending around. So the Chinese, are continuing to be a big factor. Kazakhstan, they're taking a lot of that production into China. And, so they're making sure that they have enough uranium. I've seen a number of what's their inventory, more than 500 million pounds now. And some people say, well, wait a minute, that's 12 years of current consumption. That's not relevant. The Chinese are going, it's X, and we want it to be bigger because we can store it. The one thing to keep in mind is uranium stores quite well. In other words, you put it in 55-gallon drums, that's how it's shipped, and it stores for decades. I mean, literally. So they can stockpile, uranium, virtually everything that they can buy. So the Chinese are pretty well, well along in protecting their commercial nuclear ambitions going forward. Will they meet that 100 gigawatts, 200 gigawatts? That's not relevant. I mean, they're planning for that expansion. And then they can also, on export reactors, something to keep in mind, they can go in and say, Mr. Buyer, we will supply a reactor, plus we will bring the fuel. And that's what the Russians do. And that was the Korean program in the Emirates. The Emirates had an option to buy fuel, and that's what they've been doing. So, if you sell export reactors, you really need that supply of fuel. Westinghouse Cameco, I mean, to me, was a logical group to come together because as you notice, Westinghouse does like a fabrication contract in Ukraine or Bulgaria, and then lo and behold, Cameco comes behind them with fuel, with UF6, working with Urenco on enrichment. So, there's that group that can then provide fuel in support of, let's say, Westinghouse. So again, my view is the market is changing fundamentally. You can't do what I call is walking backwards into the future and say, oh, well, we've seen this before, a little bit of demand, supply constraint, blah, 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 inventory. No, you've got to start with a clean whiteboard and say, where are we going from here? So again, back to your initial question. Sorry, I got off track.
No, that's
between now and 2030, it's going to be a significant challenge. And then when you get past 2030, is where do you go from there? I mean, you have to not only meet the needs of the current fleet with some expansion of nuclear, but then if you're going to, let's say, double, how do you produce that next 170 million pounds? So it's not going to come from Kazakhstan or Uzbekistan or Russia. It's going to have to come Canada, Australia, Namibia, a whole kind of group that's going to have to really produce a lot of uranium. It's just unbelievable.
Yeah, agreed. We can expect possible shortages of uranium. And actually, that brings me to my next question. If in one of your prior interviews, you have mentioned fuel banks as a possible source of fuel in the event of a shortage so severe that the utility was desperate. Can you elaborate on this? Would that be a government source like DOE, DOD, or maybe someone else?
Yeah, well, IAEA, they've put together a bank in Kazakhstan, DOE here in the US. But what I see happening is it develops slowly. I mean, the IAEA fuel bank in Kazakhstan took years. And I think they have the equivalent of about 1 million pounds.
Mm-hmm.
So one of the big questions is, if a utility gets in distress for fuel, it's probably not going to be one utility. It's going to be because there's been some
Multiple.
upset in the supply chain. And so how do you allocate that? You know, Mr. Utility X comes and knocks on the door, says, I have to have a reload, or this unit is going to be shut down for an extended period. It's the same thing with the waivers under the Russian sanction legislation here in the US. The question is that the utilities theoretically could get a waiver. Well, who? How do you prove you can't get fuel? You know, who gets in the queue first and all of that? Same thing with, you know, I've heard that there are apparently private groups that are looking to develop fuel banks. But with the current prices of not just uranium, conversion, enrichment, and probably not fabrication, you have a whole lot of capital doesn't buy much anymore. So, you know, how does that work? So, you know, can fuel banks be part of the market, part of the supply environment in the future? Yes. But who's going to do it? Could there be a consortium of utilities that say, hey, let's go out and accumulate a bunch of uranium or UF6? That could happen, but it hasn't happened yet. I think looking forward, there's got to be a lot of new thinking. You know, for example, investing in production. The US utilities in the 70s and 80s were involved in like 28 uranium joint ventures. It was the rare utility that had not invested in uranium somewhere. And those all pretty much went to zero. And the logic was, we're not a uranium company. We will leave it to the supply sector. Now, will they have to do it again? Possibly. I don't know. I don't take anything off the table. It's just like, just a quick note, Kazakhstan. One of your questions not too long ago was to a person well informed in Kazatomprom. And they said, no, Kazakhstan only production, that'll be it. It's the lowest cost. Chairman of Kazatomprom on the 4th of April said, oh no, we're talking to Uzbekistan, Mongolia, African countries, because we want to look at producing outside of Kazakhstan. So again, it's even within kind of the same umbrella, there's differences of opinion of where things have to go. So,
Dustin, we touched already on SMRs, or we said we are going to discuss it more. I read a very interesting study done by Mackenzie on SMRs. With global nuclear SMR project pipeline expands to 22 gigawatts. What's your comment on the study and overall SMR potential?
All right, to confess, a few years ago, I was, let's say, not positive about SMRs. There'd been a somewhat similar technology years ago called pebble bed. Different kind of fuel. It was in circular balls and stuff. Anyway, Exelon here in the US, and interestingly enough, excuse me, ESCOM in South Africa, it was a German technology, smaller units, put together in modules, blah, 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 didn't go anywhere. I'm now a real believer in small modular reactors. I think the Mackenzie study, at the 22 gigawatts. Now that's US, Canada, Poland, South Korea. You're seeing governments now saying, we really want to back SMRs. And the 22 gigawatts, I think that same study said, if you're going to go to net zero carbon in 2050, 2060, 30% of that needs to be SMRs.
Mm-hmm.
Okay. The other study that caught my attention, I'm located in Colorado, and we're all coal. Up 20 miles away, we've got coal plants everywhere. They're transitioning to natural gas, okay, before 2030. Virtually all of them are now saying, but we ultimately want to have an SMR or a series of SMRs. Kemmerer, Wyoming, the group Terra Power, which is Bill Gates, they've selected a coal site that had a coal plant. Now, will it be delayed? They said it could be delayed because of fuel availability, but let's put that aside. I think we'll start to see commercial units maybe by the end of the decade outside of China and Russia. The Canadian group has already been in the market looking for fuel. The thing to keep in mind is when people say, oh, commercial operation in 2030, 2032, you've got to build the fuel years in advance. It's just like building a big reactor. That 2 million pounds equivalent, you've got to buy 3 or 4 or 5 years before commercial operation to get that fuel converted, enriched, fabricated. The group that uses conventional fuel, which I think is NuScale, Rolls-Royce, Westinghouse, they will have a leg up. If you have to use HALEU, the only ones who produce it are the Russians, so forget that for now. The US is moving toward more capability to produce HALEU, but when? It's going to be in the future sometime. So again, DOE did a study, I think 18 months ago, where they looked at all these coal sites, and they said there could be 90 gigawatts of new SMR capacity built in the US at these old sites. So you've got grid connections, you've got, for now, labor, you've got, so it makes a lot of sense. That would double US installed capacity right there. So again, getting back to the SMRs, what I'm seeing though is the analysts are struggling with how do you model that? For example, Canaccord, they just put out a note in the last couple of days, very well done, which we would expect, but they said SMRs, we don't include in our demand because we don't really have a good feel how to model that. Now the WNA study last year started to put an SMR, generic SMR component in the reference case starts in 2031, but in the upper case starts in 2028. So the industry is struggling with how do you look at that, but it'll be more uranium demand, which we are starting to see in the market already before 2030. So.
Yeah. And which SMR technology will be the first to power artificial intelligence and data centers? Do you have any idea?
Well, NuScale, it's the only technology that's been approved by the NRC. Terra Power, I think, is moving fairly quickly. We've got X Energy with the micro reactors. I like Westinghouse. I like Rolls-Royce. I sat through a presentation by Rolls-Royce. I was ready to buy an SMR from them. So I think we'll see the bigger companies, GE, Hitachi, with their reactors. Now, that's not to say they'll be the only ones. I think we could end up, I've seen right now there's 80 technologies that have been proposed. Could we end up with 10% of that? 8 to 10 different technologies? Sure. So the question is, how do you pick that? I think part of it, though, is the conventional fuel. Westinghouse, when they just announced the AP300, it's standard fuel bundles, which they use in the big reactors. So you go, well, they know how to build those, and that will be a big plus. So that's kind of my view, not doing a lot of research yet, but conventional fuel will be a positive for near-term commercial operation.
Okay, Dustin, one question that maybe is not your specific field, but uranium equities, when can we expect a greater inflow of institutional money into a lower scale companies? I'm not talking chemicals, Kazatomproms, UEC, or NextGen. I'm talking lower scale companies. When can we expect bigger money to come into these companies?
Well, I mean, we're kind of starting it again on the deep yellow side. They just finished a raising of 200 million Australian. I think as the term market continues to show more activity, I think we'll see more big investors come in. There's a lot of interest. I spend a lot of time talking to investor groups. We have Canaccord coming up in May, Bank of America, you know, and I think we'll start to see it maybe mid-year or later as more term contracts are announced. The spot price, I think, could continue to go up, so that will be a help. But yeah, I mean, you know, trying to predict the stock market is not. There are people that do that, and I think it's, as you know, a challenge.
Yeah.
But again, the fundamentals are getting better. It's not, oh, well, the fundamentals are starting to deteriorate because of this and that and here and there. You go, no, they're actually getting stronger virtually every day. India now, you know, they want a much bigger program than they've been saying. So, I mean, it's kind of everywhere.
Yeah. Final question. It's more hypothetical. We are now in 2028, let's say. Where do you see uranium price?
Again, I think the spot price could be above 150. I don't see any constraint there. I think the term could be in triple digits. Depends on the market. In other words, if there's ongoing pressure for net zero carbon by 2050, we won't get there. But if all these kind of, I mean, the Biden administration, they've been the most pro-nuclear of anything I've seen almost ever. So you've got that, you've got the UK government, you've got the French, all the, it's a different situation than when a utility in Georgia says, I want to build 2 new reactors, as opposed to the US government going, we've got to double nuclear. Now that's a whole different environment.
Yeah.
And so we're seeing it. Japan, South Korea, I mean, you know, you go across, yeah, we've still got the Germans and the Spanish, but when you really look at it, that's already being kind of taken into account.
Yes, yes.
The Germans are the Germans, they'll do what they do. They used to have 17 reactors, but that's a whole nother story. But overall, I think we're just seeing the Swedes, they were supposed to be out of nuclear by 2020. And now it's like, how do we double? So I think, and the pressure will be constant on the uranium price in order to do exploration, to do development, to bring in skilled labor. I mean, we've had a deterioration in the availability of labor just in the mining sector. So how do you train these people up in order to do more in uranium? So it's really, you know, I hate to use the word exciting because it's overused, but it's exciting, it's interesting, it's challenging, and we'll just have to see. I don't see the price at 50. Let's put it that way. So
fair enough. That was Dustin Garrow. Dustin, thank you very much for coming to my show. It was a great chat, as I expected, even better than I expected. Thank you very much, sir.
Oh, you're quite welcome anytime as we see things continue to evolve.